Perfect competition and monopoly represent two extreme ends of the spectrum of market structures in economics. They differ significantly in terms of the number of firms, product characteristics, barriers to entry, price control, and long-run profits. Here's a breakdown of the key differences. Feature: perfect competition. Monopoly: number of firms, many small firms, single firm. Product: homogeneous, identical products. Unique product with no close substitutes. Barriers to entry/exit: no barriers. Easy entry and exit. High barriers, e.g., patents, licenses, economies of scale. Price control: price takers, no control over market price. Price maker controls the market price. Demand curve: perfectly elastic, horizontal. Downward sloping. Market demand curve. Profit in long run. Normal profits. Economic profit equals 0. Supernormal profits. Economic profits greater than 0. Efficiency: productively and allocatively efficient. Generally inefficient. Produces less and charges more. Role of advertising: not necessary. Products are identical. May be used to maintain market position or inform consumers. Examples: agricultural markets, e.g., wheat, corn. Stock markets. Public utilities, e.g., water, electricity in some regions. Patented drugs. Explanation of key differences. Number of firms. In perfect competition, there are so many firms that no single firm can influence the market. In contrast, a monopoly has only one firm, giving it complete control. Product: perfectly competitive firms sell identical products, meaning consumers see no difference between goods from different sellers. A monopolist's product is unique, and consumers have no alternatives. Barriers to entry/exit. The ease of entering and exiting a perfectly competitive market ensures that firms cannot earn long-run supernormal profits. Monopolies are protected by significant barriers that prevent new firms from entering and competing. Price control. Because perfectly competitive firms are so small relative to the market, they must accept the prevailing market price. They are price takers. A monopolist, being the sole seller, can set the price. It is a price maker. Demand curve. For a perfectly competitive firm, the demand curve is perfectly elastic, meaning they can sell as much as they want at the market price, but nothing at a higher price. For a monopolist, the firm is the market, so its demand curve is the downward sloping market demand curve. Profit in long run. In perfect competition, fierce competition drives economic profits to zero in the long run, leaving firms with only normal profits, covering opportunity costs. Monopolies, due to their market power and barriers to entry, can earn supernormal or abnormal profits in the long run. Efficiency. Perfect competition is often considered the most efficient market structure because firms produce at the lowest possible cost, productive efficiency, and allocate resources optimally, allocative efficiency. Monopolies generally lead to inefficiencies because they produce less output at a higher price than what would be socially optimal. It's important to remember that both perfect competition and pure monopoly are theoretical constructs. Most real-world markets fall somewhere in between, exhibiting characteristics of monopolistic competition or oligopoly.